Howdy there, folks. Welcome into 49-degree Las Vegas, Nevada. You know, it's a bit chilly outside, but it's not quite as cold as this stock market. This stock market's nasty. We got a lot of things I want to take you through today. A lot of things I want to talk to you about. A lot of things I want to show you that's going on in the market. A major theme change we have that's going on in the market that's going to change how the indexes work in 2023 that I want to show you guys that I think is very important and kind of what's going on there. And I'll even share a couple stocks that I think are there are some buying opportunities in this market. A lot of folks assume like you can't buy anything. And there are some stocks that are so beaten down that the valuations have gotten so compelling on P ratio basis that it actually makes sense to step in and a few dividend stocks now at this point in time. And I want to talk about a few of those. But nonetheless, it's going to get worse before it gets better. And let's be very, very clear about that. And for some of these indexes, quite a bit worse. Okay. Now, in regards to that, by the way, I hope you guys enjoyed today's videos. Always appreciate everybody that subscribe to the channel. In terms of indexes today, Dow was down over 700 points, 764 points to be exact. S&P 500 got hit bad. Russell got hit 2.5%, and the NASDAQ got hit the worst, over 3% move down here today. In terms of big tech, it was ugly. Netflix, we'll talk about Netflix a little bit later in the video, something important going on there. Intuit down 5% plus. It's one of the best business models in the world. Intuit's literally one of the best business models in the world, and it's down over 5% here today. You look at a stock like Apple, down almost 4.7%. We'll talk about Apple later on in this video. I think that's important. Meta got hit hard today, 4% move there. Tesla, we'll talk about Tesla later on in the video, somehow eked out a green there, but it did hit a multi-year low during the actual trading day. If I pull up my Cathie Wood kind of watch list here, it was ugly out there. You know, you look at Unity, which is a stock that's been just damaged time after time after time again, down another 9% plus here today. Spotify down almost 9%. Roku got hit hard. Square down about 7.5%. Coin down about 5.5% here today. Everything just getting absolutely just kind of wrecked. And then ARK in general back down to $33. Man, ARK just can't seem to get a break, right? Tesla, my Esla. Let's talk about this one right off the bat. I think Tesla's been on everybody's mind for the last, let's say, month or so, but specifically over the last few trading days. Tesla. Okay. So it eked out a very small gain. Okay. Let me explain what happened here. The news broke last night that Elon Musk sold another $3 billion plus of Tesla stock, right? So the assumption now is that Elon Musk is done selling Tesla stock in the short term, at least. Now, that is strictly an assumption. We don't know that for sure. And Elon Musk himself has said many times he's done selling, and then he ends up selling a bunch more Tesla stock, right? But there's an assumption that Elon is done selling, at least in the short term, which could be a catalyst for the stock to go higher in the short term, right? And obviously, I have my concerns for 2023 in regards to Tesla's kind of fundamentals as far as the numbers go and certain growth rates that I don't think are getting hit, right? But in terms of the short term, yeah, I can understand it being kind of a positive, right? And that's how you see, despite the Dow being down 700 plus points and despite the NASDAQ being down over 3% today, Tesla somehow ekes out a little small green day, even though it hit multi-year lows during the actual trading day. So I don't think it's necessarily something to get too excited about. It just kind of is what it is. And I say, let's just drop Tesla more. Let's get Tesla down to the 130s, start loading up on shares, and go from there. That's kind of my view on that, okay? Now, in regards to the market, where we're trading at right now, S&P 500 is down about 19% roughly. Dow's not even down 10% right now. These babies have so much further to fall, right? As far as the NASDAQ in general, the Qs were down over 32% right now. And then the Russell, about a 28% drop here. And, in my opinion, what we're going to see actually play out is we're going to watch the market go and make a major shift. And this is going to happen in 2023. And 2022 has been a year marked as inflation. It's been the inflation year, right? And so we've seen stocks get absolutely pummeled that were the higher growth names. And as obviously interest rates rose, folks were just willing to pay massively less for those companies, right? And also no one wants any piece of anything risky, money losing. We've seen that trend play out, right? And we've seen some devastation out there in general, but not as bad as we'll actually see in 2023 in regards to indexes. And you got to understand, like when you go from that inflation theme to the recessionary theme, you're going to see likely the indexes in general fall considerably more. And I'm specifically talking about the Dow, and I'm specifically talking about the S&P 500. Now, the NASDAQ and the Russell can continue to get hit as well, but what you're going to likely see is you're likely going to see the Dow and S&P perform just as bad as those, if not this is very much a potential in my opinion, those ones actually perform worse, meaning the Dow and S&P actually underperform the NASDAQ and Russell in 2023 as we get into the recessionary theme. And so when we are in the inflationary theme of this year, a lot of those Dow stocks, those S&P 500 stocks held up well, while small caps, growth names, higher valuation names, unprofitable stocks got obliterated, right? And that's just what we've seen play out. But what you see when you go recessionary theme, and you can look back at every single recession, you see the same exact thing, and including the most recent severe recession we had, which was a great financial crisis, as things really started to deteriorate in the back half of 2008 and into early 2009, what you saw is you saw even all those Dow stocks and S&P 500 stocks fall massively. And the illusion the Dow and S&P 500 were giving, it ended starting about in the summer of 2008, and those indexes started to fall rapidly as the market got more and more convinced that, we're going to have a serious recession now. And so as the recessionary fears creep in more and more, and if they go to the serious recessionary theme, you will see the Dow and S&P drop another 10, 15, 20, even 25 percentage points from here. So which would be obviously a massive kind of drop in the market, okay? And that's what you're going to see play out as the recessionary theme takes hold in the market. Now, you're seeing something very important that I want to show you, okay? Something very, very important is you're looking at stocks like Affirm, right? Affirm down another 8% today, right? The stock's down over 90% in the past year, over 90%. But a stock like this, it got hit in the inflationary theme of 2022, obviously. The stock's down 90% plus, right? But a stock like this can also get hit in the recessionary theme. So it's not like it's done necessarily going down just because the theme changes. This could have further to fall. But the more important thing is stocks like I'm about to show you right now, like a Goldman Sachs. This stock has held up tremendous in the inflationary theme, right? It's down only 11% year to date. That's a win. Only down 11% year to date. But here's the problem. This won't hold up in a recessionary theme. This stock will fall 20, 30, maybe even 40%, depending upon how rough things get. It will fall quite substantially in a recessionary theme, along with the other banks. If you have folks stop making payments, and if you have loan activity slow down massively, and just business deteriorate on a much more substantial basis, and as you get into a recessionary theme, you'll see stocks like Goldman Sachs fall quite considerably. And those are huge weights when it comes to things like the S&P 500, specifically in regards to the Dow and a lot of these big banks, right? You'll see the same exact thing play out in stocks like oil and gas stocks, where those stocks have held up very, very well in the inflationary theme. And you look at those stock prices the past year, oil and gas stocks have done tremendous. They won't hold up in the recessionary theme. If they did, that would be the first that's ever happened. That doesn't happen. Those stocks fall in the recessionary theme. And that's something we'll see play out here, okay? Now, something just happened here is retail sales came out, and they were not good. Let's just put it that way, which shows that likely this holiday shopping season is going to be one of the weaker ones we've had in some time. And I've got a comment in a moment. I'm just going to tell you why this is essentially playing out, right? But we got an interesting comment from somebody last week that works for FedEx, right, in kind of their distribution hub, and they were basically just talking about it's very weak in terms of volumes kind of coming in there, and they were expecting maybe a little pickup at right before Christmas essentially, but very, very weak volumes overall, right? And that there's could be a lot of folks kind of laid off in those facilities, or just hours cut in a major, major way in essentially early 2023, which I think you're going to see that in a ton of businesses and a ton of retailers, hours cut in a substantial way. So it's not like you were fired or you were laid off, right? It's just your hours were cut massively. And anybody that's worked in hourly positions, you know this, right? As somebody that came up in the game, right? Retailers and these other companies will cut your hours. And next thing you know, you're kind of forced to leave because you're like, oh, dude, I used to get 35 hours and now I get 15 hours. Like, that's not making ends meet, right? So you got to go try to find another opportunity if there's another opportunity out there, right? So it's kind of like a forced kind of out situation. Let's just call it that, right? Now, people are wondering, why are retail sales coming in so weak? I'll show you exactly why. That will show you exactly why. At the end of the day, when things were booming, people had a lot of money. It's as simple as that, right? And when all those companies in the back half of 2020 and into 2021 and even into the beginning of 2022 were reporting really good numbers, it's because people had a lot of money. Savings rate was really dang high. And unfortunately, over the past 6 to 12 months, It's plummeted. And now we're at places we've almost never been. So, and imagine where we're going to be after this holiday season. I mean, so we're in the worst position possible for the consumer. And we know in the United States specifically, we're a consumer-driven economy. And so if people don't have money, if the middle class doesn't have money to spend, no one's going to do numbers in 23. like that's the bottom line with that whole situation. Like the numbers will be bad. And companies will miss time and time again in 2023. Revenue, margins, EPS, like especially if it's any sort of want-based company, unless you are a needs-based company, you're likely going to face some very troubling numbers. Because at the end of the day, if people don't have money, they can't spend. It's as simple as that. It's as simple as that, okay? Now, this is beyond scary. So we're looking at the 10 and 2 year here, okay? And there's obviously, you've probably heard a lot about inversion of the 2 and 10 recently. And we've seen that, right? But the problem is it's not just that we have inversion and every time you get inversion, you get a recession. It's the fact that the inversion we have is the most insane we've seen in 40 plus years. You have to go back to the early 80s to find yield inversion this insane, okay? Now, the scariest part of this is, if you're thinking about what this means for the economy, it likely means meltdown is coming very soon, unfortunately. Because if you look at what happened the last time we had yield inversion like this, unemployment skyrocketed to well over, in the double digits. Let's just call it that. It skyrocketed to the double digits. And so what are we going to likely see over the next 12 months? We're unfortunately likely going to see unemployment climb in a substantial, massive way. I don't know if we're going all the way to double digits. I'm not going to make that prediction. But are we going to go to at least 5, 6, 7%? I think that's highly probable. Let's just put it that way. And so there's a long way to go in terms of the whole unemployment game. And in 2023, I think just in the first half of the year, you're going to see the unemployment rate tick up in a massive, massive way. But it won't be on the Fed's radar until we go around 5% or above. That's when the Fed's going to start paying attention. And that's a moment that if you get inflation down enough and unemployment's climbing in a substantial enough way, that's a moment that the Fed could potentially actually do what everybody wants the Fed to do, which is pivot. But the problem is we're not getting that until at the earliest, likely the summer of 2023. That's the earliest, is summer of 2023. So we've got this very kind of bad, awkward time to work through here, folks, that the market is not going to get any help from the Fed. At some point, the Fed will do the pivot, and they will start to help out the market. But it's not until you see that unemployment tick up in a massive way and simultaneously inflation's down in a substantial way. And that's still, we got some time to play out. So in that time period, the market can absolutely tank. And I mean absolutely tank. You see things like this, right? Very reminiscent of what we went through in the housing bubble, which I think we're in just as bad of a housing bubble right now as we were back then. And if you look at things like this, right, home flipping profits drop at the fastest pace in over a decade. Yeah, if you're a home flipper and you haven't dumped your properties, I don't know what you're doing, man, but you should have dumped those babies quite a while ago. But this is what we're going to see playing out. You don't know, there's so much speculation that got into the real estate market over the past couple of years. Home flippers, real estate investors, companies buying properties, so much cheap money, and all that has to be unwound now at this point in time. It was so unnatural and so unhealthy. It all has to be unwound, and sometimes that takes several years to play out. And we saw this in the housing bubble bust. You saw this. It took a while for all these unleveraged properties and short sales and all these sorts of things to come. And we haven't even seen the short sales in the foreclosures or anything like that. But you're gonna hear things like short sales and foreclosures, which are things you haven't heard since pretty much the great financial crisis. And you're gonna hear terms like that start to skyrocket. You're gonna see Google Trends skyrocket for terms like short sale of homes. You're gonna see Google Trends skyrocket for things like foreclosures. And that hasn't even really played out yet. That will start to play out in 2023, unfortunately, as bad as it sounds. Now, there is a stock that I own that just reported earnings, okay? And this is a new kind of position for me. I kind of wish I would have reported bad numbers because I want to build out this position a lot bigger in 2023. But they reported really good numbers. It's Adobe. And the stock's up after hours. Earnings per share was up, came in better than expected, 360 versus 350. Revenue came in right in line. Business very healthy. Companies like Adobe, are going to do well regardless of what happens in the economy. Obviously, they're going to do better in a good economy. It's as simple as that. But a stock like Adobe, in terms of the company, can the stock price fall in 2023? Absolutely. And I expect Adobe stock price to fall in 2023. Let me be very clear about that. But with that being said, a company's fundamentals like Adobe are going to be good regardless of what happens in the economy. Shallow recession, mid-recession, bad recession, Adobe's going to be fine. They'll be profitable. They got a great balance sheet. And so you're going to have companies that perform regardless of what's going on in the macroeconomic landscape, right? Which is not going to be an ideal one by any stretch of the imagination. I probably say that term a little too much, any stretch of the imagination, okay? Netflix down big here today, down 8.6%. Now, you might be wondering, why the heck is Netflix stock down? Okay. The reason Netflix stock is down is because there's kind of like rumors out there that Netflix is a new ad business is not performing well. And, Netflix might even be giving back some money to some customers because it's not performing well and those sorts of things, right? And there's something about they're supposed to be hitting 100% of the ad market out there in terms of, like 100% fill. And sometimes it's only like 80% of the audience is out there watching and things like that, right? Which is not ideal for Netflix. And so which means their ad-supported product is getting off to a little bit of a rough start. Now, my personal opinion is I think it's ridiculous that people draw all these conclusions about short-term things for a business Netflix just started up. That ad business, I'm sure, has massive long-term potential, right? And so the fact that people are flipping out over this is kind of comical. I think people are just looking for a reason to take some profits in Netflix because, let's be honest, if you bought this stock in early summertime, you're up so massively, it's ridiculous. I mean, this stock since the early summer, May, June, somewhere around there, is up, 60, 70%. So you've done so well, I think people are looking for a reason to take some profits in this one. And I think a lot of folks are expecting the stock to go back down to $200 or so, which I wouldn't be surprised, especially if the indexes get hit. Could Netflix go back down to 200? Sure, absolutely it could. And but at the end of the day, I think it's a little short-sighted that people are getting all in their feelings about this whole ad situation. I'm like, they just started that business, and that's got 5, 10, 15, 20 years of runway in front of it, right? Apple. Have you seen Apple today? The stock is down 25, or it's not down 25% today. It was down almost 5% today. It's down now about 25% year to date. And here's something very important in regards to Apple, okay? In regards to pricing action. What is the stock telling us? It is telling us it is getting ready for the recessionary theme. That's what it's telling us. And in the recessionary theme, can the stock go down to, let's say, a 50% drop from where it started out in 2022? Absolutely. Absolutely. At the end of the day, there's no way that if you're talking about the economy is going to get much worse and you're talking about people don't have money, there's no way Apple's reporting great numbers in 23. They're going to report down numbers. iPhone, Mac, iPad, every business line. Maybe Apple Watch could eke out gains in 2023 because they got a new kind of exciting product there. And it might be the one that can sneak by. But in terms of basically every other product line the company has, it's not going to be a good situation. Plus, they're going to have scrutiny more than ever about their whole app store model and the whole 30% fees and all those sorts of things, right? So, and analysts are still in complete delusion when it comes to this. And I think shareholders are starting to realize that analysts are in delusion when it comes to this. Analysts have Apple growing EPS in 23. They have them growing revenue in 2023. And I think as the market gets more and more into the recessionary theme, I think people are going to realize that's a far-fetched fairy tale. And the more of the question is, does Apple's revenue shrink 5% or 10% or 15% in 2023? Because if you're talking about people don't have money to spend, the economy is going to get far worse. I'm just telling you, like people are not going to upgrade their products the way they've been upgrading their products in a great economy. We haven't seen, actually, think about this for a moment. We haven't seen the massive Apple company go through a severe recession with their whole new product lineup. We've never seen that. Think about this for a moment. When the iPhone came out, the great financial crisis was just going on, right? When iPhone came out, iPad wasn't even around back then. Neither was Apple Watch or AirPods or all these different products. So we have not actually seen Apple go through a major recession. We don't know what that means. We've only seen Apple's business grow as the whole economy grew and everything got great, right? And so, yeah, they sold more iPhones and more iPads and all these devices, right? But we know Apple's coming off of multi-record years, where they came off a record year, 2020 record year, 2021 record year, 2022 record year, right? And 2023, I just think, is just setting up for a nightmare for Apple. And analysts are still in this delusional state of thinking Apple's going to grow in 23. I don't see it. I really don't see it. It's a possibility, as all things are, but I think it's a very much a far-fetched fairy tale, and I think investors of Apple are starting to wake up to this, and that's why they're starting to dump out of this stock, because they realize, oh boy, this whole thing that we think's going to happen is not happening. There are certain opportunities in the market that I think are great buys, right? A stock like Foot Locker, it's not the most exciting stock. Absolutely not. But at the same time, a stock like Foot Locker has been hit heavily. It's trading at such a massive discount. It's got a great dividend yield that I think a stock like Foot Locker can hold up decent in 2023 because the valuations come down so much. And it just, at some point in time, it just gets hard to push these stocks down anymore. And when you got a great dividend yield and you're a profitable company, you're a cash flow company, you're set up in a pretty darn good position. So a stock like that, I look at, even a stock like Nordstrom, another one that's been pushed down so dang much that I think the stock will hold up pretty darn well regardless of what happens in 2023, and will do pretty well. And so, you're going to have certain opportunities in the market that present themselves, right? And in terms of myself, when am I looking to get out there and start buying again? Because I think a lot of folks are wondering that. I'm looking to get back out there in the first quarter of 2023, specifically around February, March, as far as being an active buyer in the market. Right now, I'm in chill mode, and I'm letting just kind of everything just drop out, right? And if everything continues to drop through the rest of this month, which it's been a pretty bad month so far in December, and drops into January on more recessionary fears, I'll likely step back in terms of an active buyer in likely February, March. But right now, I'm just kind of in chill mode. I did buy, a decent position just to hedge as far as the SDAO calls, right? Just to kind of hedge, just in case the stuff hits the fan in 2023 and things get really ugly really fast for the indexes, just so I'm hedged there, right? But outside of that, as far as long positions, I'm going to look to add back, into an active buyer stance in that first quarter of 2023. And then just kind of use 2023 as an active buyer year. It's going to be rough for a lot of companies, guys. I just got to call it the way I see it. It's going to be rough for a lot of companies. A lot of companies aren't going to report growth. They're going to report declines in their businesses in terms of earnings per share, in terms of revenues. It's not going to be all companies. Some companies are actually going to have their EPS and their margins getting actually a much better place in 2023. But the problem is those sorts of companies aren't the index movers. Honest's margins are going to improve a lot in 2023, and there's going to be certain other stocks that their margins improve and their profitability improves in those sorts of metrics, right? But those aren't the market movers. The fact is, the ones that move the markets, those ones' revenues are likely going to not increase nearly at the rate that analysts think they're going to increase. Some of them are going to go down, meaning their revenue is going to shrink, which is going to put the investors in a totally different mindset. And a lot of companies' EPS and net incomes are going to go down. Cash flows are going to go down. It's going to get in a worse position, right? And so and those are the index movers. Those are the ones that run the Dow and run the S&P 500 and run the Qs as well. And so that's just something to kind of keep in mind there. And so, yeah, I'm going to use just 23 as obviously buying opportunities. It's going to be tough sledding. It's going to be tough sledding for so many companies, guys. It's not even funny. It's just kind of the way it is. And you're going to have those years in the economy where that happens, and it is what it is. Make sure you guys check out the video I posted last night. It has a great video and goes very in-depth on many different subjects that you're just going to want to make sure you check that video out if you did not already watch that. Also, if you want, a few nights ago, I did a whole video on Honest in terms of their latest Morgan Stanley conference. And it's just a great video to learn from. So if you want me to email you that video over, or I can text you that video over, just enter in your email. That'll be pinned comment down there, and I'll send that video over, and you can watch it and check it out. I think it's just something good to kind of learn from as far as me going through that video. Much love as always. Appreciate you, and have a great day.